The process of portfolio management involves two key decisions: the asset allocation decision and the security selection decision. In this learning objective, we explore the concept of asset allocation. Asset allocation is the process of determining how an investor allocates their total wealth across different asset classes. For example, it's the question of what proportion of your wealth to invest in property, what proportion to invest in equities, what proportion to invest in bonds, and so forth. When making the asset allocation decision, an investor will consider their own personal characteristics such as risk tolerance, goals, and investment timeframe. There are two different approaches to asset allocation: strategic asset allocation and tactical asset allocation. With strategic asset allocation, the primary goal is for an investor to look at their own personal characteristics, and most importantly here is their degree of risk aversion, and to come up with a mix across asset classes that can best meet those particular characteristics. The only way that the asset allocation then changes with respect to strategic asset allocation is through rebalancing back to the original position that was held, such that over the long run, the portfolio continually reflects the particular objectives and needs of the investor. Tactical asset allocation, on the other hand, is more commonly known as market timing. This is the process of dynamically allocating across asset classes based on predictions on how markets are going to perform in the future. So, for example, if an investor is of the belief that markets are going to do well generally in the future, then they will dynamically allocate a large proportion of their wealth into higher risk assets such as equities. Whereas if they think that financial markets generally are going to perform poorly, they will dynamically allocate their assets towards low risk or risk-free assets. Well, when most people think about investing in portfolio management, they focus on the idea of security selection. That is, they think of investing as the question of whether to invest in BHP versus Commonwealth Bank shares. The asset allocation decision is in fact arguably more important. Research has shown that asset allocation provides a large proportion of the variance in performance across different fund managers. For example, the quote that we see on the screen here is a statement that says that up to 94% of differences in total returns achieved by pension funds can be attributed to the asset allocation decision. Similarly, academic studies have found that the proportion of overall difference in performance is anywhere from 90 up to 97% explained by asset allocation. So while the number itself varies across different studies and different statements, the point to stress remains the same. Asset allocation decision dominates the investment process, hence it's a really important consideration for all investors. So let's very quickly have a theoretical look at what asset allocation is all about and why it might be important. Recall that if we've got assets in one particular asset class, so let's say for example here we're looking at equities, we have a feasible set of investments. The feasible set are all the potential portfolios that can be constructed using a universe of equities. And that feasible set will be this cloud here, where we can basically be anywhere within that cloud, although obviously we want to be on this efficient frontier at the top here, because that's where we have the highest expected return for a given level of risk. Previously we've seen that we can combine our equities asset class with a risk-free rate of return and construct this new efficient frontier, which is the combination of the optimal risky portfolio at this point of tendency and the risk-free rate of return. Now that particular example we showed there was where we had one risky asset class, that was equities. So these red dots might reflect the risk and return of all the different stocks in our universe, and we came up with that efficient frontier such that A is our optimal risky portfolio, where our universe of assets only comprises equities. But what if we suddenly add additional asset classes? So what if here, for example, we have the green dots, might be bonds, the orange dots might be investments in property, and the blue dots might be investments in another asset class such as currency, for example. Well, if we're combining across these multiple asset classes, we're expanding our universe of potential investments. And what we also find is when we tend to diversify across asset classes, that Across asset classes, assets have lower correlations than what they do within an asset class, hence there are greater diversification benefits. Given these benefits, what we tend to find is that the efficient frontier actually pushes outwards, such that we have a new optimal risky portfolio comprising the combination of risky assets across all asset classes that has been pushed further out, and when we combine that new optimal risky portfolio with a risk-free rate, we have this combination of assets that is actually superior to our previous optimal risky portfolio. Okay, we can see in this particular example, if we can combine B with the risk-free rate of return, we can come up with a portfolio C which dominates A. That it is clearly superior. So this is the theoretical reason why it's important for investors to consider allocating across asset classes and why it is arguably the most important decision that they might make.